Hello everyone, welcome to OTHM Level 6 Diploma in Business Management. So today we are going to discuss Unit 4, that is about financial decision making. First we have the first learning outcome in which we try to understand the role of financial information and financial analysis in business risk assessment and decision making. So we have the first assessment criteria in which we analyze the factors that guide and drive decision making in business. So there are some factors. For example, the business decision are influenced by shift in demands, emerging markets, and overall industry direction. The companies can adjust their strategies to meet evolving customer expectations and feedback. And decisions hinge on profitability, cash flow, and financial stability. And it monitors the competitors to stay ahead and make strategic moves. It complies with laws and regulations, which includes tax laws and labor laws. Decision making must consider adopting or avoiding new technologies that can either disrupt or enhance business. Now we have some business structures. First, we have the sole trader, which means there is quick decision making limited by personal financial capacity and resources. Then we have partnership, which means collaborative decision making balancing multiple viewpoints. Then we have limited companies, which means more formal decision making process due to legal obligations. Then we have public limited companies, which means decisions are driven by shareholder interest, public security, and stringent financial reporting regulations. Then we have different business structure again. For example, public sector organization which focus on public good. Then we have cooperatives, which means democratic decision making. Then we have international business structure, which means decisions are always influenced by global market trends. Then we have the second assessment criterion, which we assess the significance of financial factors in business decision making. So we have different significance that it ensures that designs align with generating sustainable profit, cash availability influence the decision, balancing cost against revenue potential to make decisions that maintain profitability, decision on whether to use internal reserves, loan or equity financing directly affect the company's financial health. Financial factors guide decision by assessing the potential ROI on any strategic initiatives. Financial health always determine decision aimed at avoiding bankruptcy, ensuring debts obligations are met. Then we have different financial reporting for different business structure. For example, if we talk about sole trader, then minimal reporting requirement is there, and here is a simpler financial decision making process. If we talk about partnership, then it requires detailed accounting of profit and losses, and it has the joint decision making which tied to financial standing. If we talk about limited companies, then it's subject to formal financial reporting standard and decisions heavily influenced by shareholder expectations. Then we have the third assessment criteria in which we evaluate the characteristics of business risk that impact on financial and business decisions. So there are some characteristics of business risk in financial and business decisions: operational risk, market risk, financial risk, compliance risk, strategic risk, and at last we have reputational risk. Then we have compliance risk, which means that the risk of not adhering to legal and regulatory requirements. Then we have a strategic risk, which means risk arising from flawed business strategies, for example, entering the wrong market. Then we have reputational risk, which means damage to the company's image or reputation that can result in loss of customers. Then we have the second learning outcome, which in which we will try to understand how financial statement and their structure aid the business decision making. So we have the first assessment criteria in which we compare accrual and cash flow approaches to accounting and financial reporting. So what is accrual cash flow and what is accrual flow and what is cash flow? If we talk about accrual accounting, then it means that revenue and expenses are recorded when earned. And if we talk about cash flow accounting, then it is the revenue and expenses are recorded only when cash is received or paid. Accrual accounting is always long term and cash flow accounting is short term. In accrual accounting, there is income statement and balance sheet. In cash flow accounting, there is cash flow. Accrual accounting is more complex. Cash flow accounting is simpler. And accrual accounting helps in long-term planning, and cash flow accounting is useful to manage day-to-day cash flow. Accrual accounting always required by accounting standard, and cash flow accounting may be used internally for cash management. Then we have some statement of cash flow and accrual basis reporting, which means that the statement of cash flow tracks how cash is generated and spent during a specific period, and it has different categories which include operating, investing, and financing activities. Accrual reporting appears in income statement and balance sheet. It focuses on profitability and overall financial performance instead of actual cash flow. The cash flow of accounting helps with decision on immediate liquidity, and accrual accounting always aids in long-term strategic decision based on financial health and profitability. Then there are some implications of these accounting and decision making. It's very simple. You can just read it and you can get the idea because I have already explained the concept of accrual and cash flow accounting in previous step. Now we have the second assessment criterion, which evaluate the structure and content of final account and their uses for decision making. So we have some published financial statement. First, we have balance sheet, which provide the snapshot of company's asset, liabilities, and honor equity. If you talk about income statement, then it summarize revenue, expenses, and net income. If you talk about cash flow, then it shows the cash flow and outflow categorized by operating, investing, and financing activities. There are some rules of auditor and final accounts. For example, auditor always review the financial statement to ensure the accuracy. They provide assurance that the information is reliable. An auditor's opinion always adds credibility to the financial statement, and it helps the business to make informed decision. It helps in the decision making, and it gives the stakeholder confidence in the financial health of the company. Then we have published versus internal financial information. If you talk about published financial information, then it includes externally shared documents, for example, balance sheet, income statement, and cash flow statement. If we talk about internal financial information, then it includes more detailed report that are used internally. If you talk about impact on decision making, then published statement gives a high level overview used for strategic decision and external stakeholder relations. Funds. We have some key financial statement. I have already explained to you guys before that what is balance sheet. It shows the company's asset and liability. Income statement shows the revenue and expenses. Cash flow shows the inflows and outflow of the cash. Now we have to interpret the income statement. It summarizes the total revenue earned during a specific period. It gives the detail about the operating and non-operating expense. It shows the company's gross profit and net profit. It provides the insight into overall business profitability and performance. It helps to analyze the revenue trend and cost structure over time. Now we have some financial ratios. First, we have profitability ratio, and in profitability ratio, we have total four ratios. First, we have gross profit margin, which measures the percentage of sales revenue exceeding the cost of goods sold. Then we have net profit margin, which shows the percentage of revenue left after all expenses are deducted. Then we have ROA, that is return on asset. It indicates how efficiently a company uses its asset to generate profit. Then we have return on equity, which measures the return generated on shareholders' equity investment. Then we have liquidity ratio, in which we have three ratios: current ratio, quick ratio, also known as asset test ratio, and then we have cash ratio. Current ratio basically assesses the ability of the company to cover its short-term liabilities with the help of its asset. And quick ratio or asset test ratio basically evaluates the ability of the company to pay its short-term obligation without inventory. That's why in its formula we subtract the inventory. Then we have cash flow ratio, which measures the liquidity based solely on available cash to meet liabilities. Then we have the capital ratio, and we have three ratios, and it's debt to equity ratio, debt to asset ratio, and trust coverage ratio. Debt to equity ratio basically shows how much of the company is financed by debt versus equity, and debt to asset ratio basically indicates the proportion of asset finance through debt, and interest coverage ratio basically measures how easily a company can cover interest payment with its earning. Then we have investor ratio, and we have three main ratios of it, that is price to earning ratio, price to book ratio, dividend yield. Price to earning ratio basically shows how much investors are willing to pay for each euro of earning, and price to book ratio basically compares a company's market value to its book value. Dividend yield basically reflect the return investor can earn through dividends relative to stock price. Then we have efficiency ratio, and we have three ratios in it, that is inventory ratio, asset turnover, receivable turnover. If you talk about inventory turnover, then it measures how efficiently inventory is managed by comparing the cost of goods sold to average inventory. If you talk about asset turnover, then it indicates how effectively a company uses its asset to generate revenue. If you talk about receivable turnover, then it assesses how efficiently a company collects its receivables. Now we have to discuss some calculations of these ratio. Here is the uh, some figures, you can say, of some assumed company, and we will get help from these figures to calculate the ratios in the next slides. So first we will calculate the profitability ratio. You can see that we just simply entered the figures in the formulas and we get the answers. Here is the interpretation of the profitability ratio, which is important now. So gross profit margin was 50%, which indicates that for every $1 or £1 of sales, the company retains 0.050 pound or dollar as a gross profit, which reflects strong control over production or service cost. Our net profit margin was 10%, which shows that 10% of total revenue is converted into net profit, which means company retains $0.10 or pound of every $1 or pound after all the expense, which indicates moderate profitability. If we talk about ROA, that is 12.5%, which suggests that company is efficiently using its asset. If we talk about ROE, return on equity, it is 25%, which reflects that the company is providing a strong return to its shareholders. Now we have the calculation of liquidity ratio. So here again, you can put the figures in the formulas and you can get the values easily. Then we have the interpretation. Current ratio is 2.0, which means that company has 2 pound in current asset for every 1 pound of current liabilities, which shows the good short-term financial health. If we talk about quick ratio, it is 1.6, which shows that company has 1.60 pound in liquid asset for every 1 pound, and it shows the strong ability to cover immediate obligation. If we talk about cash ratio, it is zero point 0.6, which shows that company has 0.60 pound in cash or cash equivalents for every 1 pound of current liabilities, which shows that it might need other liquid assets to fully cover its short-term debts. Then we have the calculation of capital ratio. Again, just simply put the figures in the formulas and you will get the answers. Then we have investor ratio. Again, just put the values in the formulas and you will get the figures. Now we have the calculation of efficiency ratio. Again, just simply put the figures in the formulas and you will get the answer. Then we have industry benchmarking. Benchmarking is the process of comparing a company's performance with industry standards or top competitors. It helps to identify the areas of improvement and best practices by evaluating performance gap. It includes the internal and external competitive and financial benchmarking. It commonly measures the metrics which include profitability, efficiency, liquidity, and customer satisfaction. It drives the continuous improvement which enhance the competitive advantage. And benchmarking always results to inform business on how to optimize processes and stay ahead in the market. So here is some example. For example, if gross profit margin from our example was 50% and industry benchmark was 40%, it means that company outperforms competitor in controlling production cost. Our net profit margin was 10%. For example, industry benchmark is 8%, which means that company efficiently manage expenses leading to better profitability. Our ROA was 10%. Sorry, our ROA was 12.5% and industry benchmark is 10%, which shows that company is more effective. Our ROE was 25% and industry benchmark was 20%, which shows that companies deliver a higher return. Our current ratio was 2.0 and industry benchmark was 1.5, which means our country is better positioned to cover short-term obligations. Our quick ratio was 1.6 and industry benchmark was 1.2, which shows that our company has better liquidity. Our cash ratio was 0.6 and industry benchmark was 0.5, which means that our company maintains the healthier cash reserves. But there are some limitations of financial ratio, like they are based on past performance and they may not predict future trends or challenges. And the comparison across different industries can be misleading due to varying the benchmark and practices. And companies may manipulate financial statement to present more favorable ratios. And ratios don't consider qualitative factor, for example, market condition, management, quality, or brand value. And ratios provide a snapshot at a specific point in time and may not reflect long-term financial health. And ratios don't account for inflation, which can distort comparisons over time. Now we have the fourth assessment criteria in which we differentiate between financial decisions relating to capital expenditure and those relating to revenue expenditure. In this slide, we will explain the difference between capital expenditure versus revenue expenditure. So, what is capital expenditure? It is a long-term investment in the non-current asset, and revenue expenditure is a short-term expense related to daily operations. The capital expenditure always provide the benefits over multiple years, and revenue expenditures provide benefit within the current accounting period. The capital expenditure means purchasing inventory, buildings, or equipment. The revenue expenditure means repairing the equipment, utility bills, or routine maintenance. If we talk about capital expenditure, then it affects the balance sheet as the assets is capitalized. And if we talk about revenue expenditure, then it affects the income as it is fully expensed in the period. If we talk about capital expenditure, then it is typically financed through long-term loans, and the revenue expenditure is typically financed through operational revenue. Capital expenditure increase the company's asset, and revenue expenditure affect the company's current profitability and cash flow. Now we have the third learning outcome in which we would be able to perform effective capital expenditures appraisal using the range of technique. So we have the first assessment criteria in which we appraise the different sources of short-term and long-term finances for business. So we have different type of short-term financing options. The short-term financing is used to cover immediate day-to-day operational needs and working capital, and it has different sources. For example, bank overdraft, which provide immediate cash flow relief, helping the business to cover the temporary shortage. The second source is the trade credit, which allow the business to delay the payment to suppliers, which improve the cash flow. Then we have the short-term loans, which is used to address the urgent operational needs or to finance short-term project. Then we have factoring, in which we sell the receivables to finance immediate cash needs. Now we have the second assessment criteria in which we critically examine the key factors that affect the choice of source of financing. So we have some key factors, for example, cost of finance, impact of financial statements, tax implication, cash flow consideration, and availability of resources. If we talk about its critical analysis and what is cost of finance, it is basically the higher interest rate on debt that reduce profitability. If we talk about impact on financial statement, then it is basically the debt financing which increase the liability and leverage. If we talk about tax implication, then it is the interest on debt that is tax deductible and which make the debt financing more attractive in high tax environment as compared to equity. If we talk about cash flow consideration, then it is basically the short-term financing that can create immediate liquidity. And if we talk about availability of resources, then it is the internal finance that is limited by a company's reserves. So we have different techniques, for example, net present value, discounted cash flow, internal rate of return, payback period, accounting rate of return. Now we have the fourth assessment criteria in which we explain the possible benefit and drawbacks of the off balance sheet finance. Now, there are some drawbacks of off-balance sheet financing. It may obscure the true financial position of the company, which leads to distrust from investor or regulators. It can attract security from regulators if seen as an attempt to manipulate financial statements. The company may still be liable for obligations associated with off-balance sheet items, increasing hidden risk. It requires sophisticated accounting techniques and may involve higher costs in managing and reporting. If the investor and stakeholder can question the company's integrity if they perceive the use of balance sheet as deceptive. Now we have the fourth learning outcome in which we would be able to evaluate how different ownership structure impact on financial performance. So we have the first assessment criteria in which we critically analyze the corporate governance, legal and regulatory environment of different business ownership structure. So first we have corporate governance across different business ownership structure. First, we have sole trader. It means that owner make all the decision. If we talk about partnership, then it is the shared decision making among the partners. And in case of limited companies, there are board of director that oversees the operation. If we talk about public limited, then it is the strict governance due to the public ownership. And at last, there are cooperatives, which means democratic decision making by members. Now we have the second assessment criteria in which we compare and contrast stakeholder interest of owner and managers in decision making. Now we have the third assessment criteria in which we evaluate the significance of return on capital, earning per share, and other overall performance measure for the long-term sustainability of business. So what is the significance of return on capital employed? It measures the efficiency and profitability of capital investment. The high return on capital employed always shows the effective use of capital to generate profits, and it always allows the comparison with competitor and across different industries. It helps the investor to evaluate whether the capital is generating sufficient returns or not, and it indicates the long-term profitability and business sustainability. And the strong ROC always ensures that company remains competitive and viable. Now we have the significance of EPS, that is earning per share. It represents the portion of profit allocated to each outstanding share. The higher EPS signals a strong profitability and attract investor. It is the consistent EPS growth which boosts the confidence of the shareholder, and it enhances the access to capital for future project and expansion. It is directly linked to creating the value for shareholders. And a higher EPS strengthens the market position of the company and its long-term sustainability. Now we have the fourth assessment criterion, which we differentiate between business ethics, governance, and accounting ethics as control on business accounting. So thank you so much. This is all about Unit 4 of the Level 6 Diploma in Business Management. If you have any question, please feel free to ask. Thank you.